Hi, welcome to today's deep dive lessons from the Intelligent Investor. Introduction to Value Investing. Value investing is an investment strategy focused on buying securities that appear to be undervalued by the market. The goal is to invest in companies whose stock prices are lower than their intrinsic values, which are based on their assets, earnings, and long-term growth potential. This approach emphasizes careful analysis, patience, and discipline rather than speculation or trying to predict short-term market trends. Investment versus speculation. Investment is a decision based on thorough analysis, promising safety of principal and an adequate return. Speculation, on the other hand, involves risking capital based on predictions and market timing. The core difference lies in the approach and intent. Investors focus on the long-term value, while speculators are often driven by short-term price movements and trends. Investors protect themselves by focusing on fundamentals rather than market moods. The defensive investor. The defensive investor seeks to preserve capital with minimal effort and limited risk. This type of investor avoids aggressive strategies and focuses on creating a balanced, diversified portfolio. A simple portfolio with a mix of high-grade bonds and quality common stocks is recommended. The defensive investor should not attempt to beat the market, but should aim to achieve satisfactory returns through consistency, patience, and disciplined asset allocation. The enterprising investor. The enterprising investor is willing to devote more time, energy, and skill to investing. This investor seeks above-average returns by conducting detailed analyses and exploiting market inefficiencies. Enterprising investors may look for undervalued stocks, special situations, or bargain issues. They must stay disciplined, conduct thorough research, and avoid emotional decision-making to succeed. The importance of the margin of safety. The margin of safety is the principle of purchasing securities at a significant discount to their intrinsic value. This cushion protects investors against errors in analysis, unexpected market declines, or unforeseen company problems. By ensuring a margin of safety, investors reduce the chances of significant losses and increase the potential for satisfactory returns, even if some judgments prove incorrect. Understanding market fluctuations. Markets are inherently volatile and subject to fluctuations influenced by investor psychology, economic news, and global events. Investors should not react emotionally to market swings. Instead, they should see market fluctuations as opportunities to buy undervalued securities or sell overvalued ones. Recognizing that market prices can deviate widely from intrinsic values helps investors maintain a rational perspective. Mr. Market analogy. Mr. Market is an allegorical figure representing the stock market's daily mood swings. Sometimes Mr. Market is overly optimistic, offering high prices, and sometimes he is pessimistic, offering low prices. Investors should not follow Mr. Market's mood, but should make decisions based on the value of the underlying business. The key is to take advantage of Mr. Market's irrational offers without being influenced by them. Stocks as part ownership in a business. When buying stocks, an investor is purchasing a share of a real business. This perspective encourages careful selection based on the company's performance, management quality, financial health, and long-term prospects. Investors should think like business owners rather than traders. By focusing on the company rather than stock price movements, investors can make more rational and informed decisions. The role of financial analysis. Financial analysis is essential for understanding a company's true worth. Investors should examine balance sheets, income statements, earnings trends, dividend records, and financial ratios. Analyzing a company's financial position helps determine whether its stock is undervalued or overvalued. Investors should compare companies to their competitors and evaluate their earnings stability, growth potential, and debt levels. The concept of intrinsic value. Intrinsic value is the true worth of a company based on its fundamentals, independent of market price. Calculating intrinsic value requires analyzing assets, earnings, dividends, and future growth prospects. The difference between intrinsic value and market price creates investment opportunities. Investors should aim to buy when the market price is significantly below intrinsic value, providing a margin of safety. Dividend policy and stability. Dividends provide a steady income stream and can indicate a company's financial health and stability. Companies with consistent and sustainable dividend payments are often financially sound. Investors should favor companies with a history of stable or gradually increasing dividends. This approach offers reliability and can cushion against market volatility. Inflation and investment decisions. Inflation erodes purchasing power and can impact investment returns. Investors should consider the effects of inflation when selecting assets. Stocks with growth potential, bonds with inflation protection, and real assets can help offset inflation's impact. Understanding inflation trends is crucial for preserving and growing wealth over time. Defensive portfolio strategies. A defensive portfolio typically includes high-grade bonds and diversified, well-established stocks. Investors should balance the portfolio to suit their risk tolerance and periodically review asset allocation. Diversification across industries and asset classes helps reduce risk. Avoiding complex or speculative investments can further protect capital. Enterprising portfolio strategies. The enterprising investor can pursue special situations, bargain issues, and undervalued growth stocks. These strategies require careful selection and a willingness to invest time in research. Investing in companies that are temporarily out of favor or overlooked by the market can yield attractive returns if their fundamentals remain strong. Common stock selection for the defensive investor. Defensive investors should focus on large, financially stable companies with a record of consistent earnings and dividends. Companies should have a history of profitability and resilience during market downturns. Selecting stocks from different industries further reduces risk. Investors should avoid new, unproven companies and those with erratic earnings histories. Thank you for listening, and please like the video and subscribe for more great upcoming content that will put you in top 1%.